right, Chapter 18, Public Finance. This is going to be the study in the various ways that governments raise and expend money. All right, so looking back at our circular flow diagram. Okay, and here we have households, businesses, the resource and product markets like we did earlier, except now we have also added the government over here. And so what we see is that the government provides goods and services to households, and households pay taxes to the government. The government also provides goods and services to businesses. Businesses pay net taxes to the government. Okay, the government spends that money in the product market to buy goods and services. So we can look over here. And then goods and services flow back to the government. Okay. And also they spend money in their resource market, and resources flow back to the government as well. Okay, government purchases, they are exhaustive. What exactly does that mean? It means that the products that are purchased, okay, require the use of resources, and they're part of domestic output. So in the book it says the purchase of a missile, uses the labor of physicists and engineer along with resources such as steels, explosive, and a host of other inputs. If they're going to build a new school, it's going to require the labor of construction workers, architects, also to hire teachers, and then all the inputs, physical inputs to build a school, concrete, wood, steel, etc. Transfer payments are non-exhaustive, meaning they don't use resources or create any type of output. Unemployment benefits, welfare benefits, any type of social security benefit, they don't contribute to domestic output. It's the reason why they're not included in GDP. So when we look at, what goes in GDP, government purchases is part of GDP because they contribute to output, but transfer payments aren't part of GDP because it's just a transfer of income from one person to another. They're not producing any output, so therefore they are non-exhaustive. Okay, the government can engage in deficit spending, and this is essentially when they spend more than their income. Their income comes from, for example, taxes and also the profits made by any type of enterprise that the government owns. And during times of recession, this may be desirable to help stimulate the economy. This would be part of fiscal policy, is increased government spending during economic downturns to help bring the economy out of a recession, boost GDP, in other words. During a recession, the opportunity cost of borrowing is low because usually businesses are not using the available funds as much for investment purposes. They might be a little hesitant to expand during downturns. So the opportunity cost of the government using the money instead is low. However, during economic expansion times, the opportunity cost is higher because the more the government uses that pool of funds, then the less there are for businesses that could also use them and grow and expand GDP. Okay, we can see that total government spending has increased throughout the years, and we can see that the reason for this increase has been an increase in government transfer payments. Overall, government purchases have slightly declined, but government transfer payments have tripled. Okay, and just a quick chart to show the total tax revenue as percentage of GDP. So for United States, the United States tax revenue as a percentage of GDP is 25%, which is very moderate, meaning, we don't pay extremely high taxes. For example, as Denmark, Sweden, France, Finland do for, as you can see in this chart. Of course, there's always a trade-off, right? Denmark, college, for example, is quote-unquote free. Healthcare is quote-unquote free. It's not really free, right? There's no such thing as free lunch. It's just that population pays much higher taxes and it spreads out into social benefits. These countries believe that, a better educated society leads to higher output and lower crime, which is not exactly a false statement. There's a lot of validity to it. Also, healthcare is a right, not a privilege, etc. So their belief system is a little bit different. All right, and also we can see how our government spends their money and earns their money. Okay, so if we look on the right, personal income taxes, those are the taxes we pay as individuals from our income. Here in the United States, the personal income tax is a progressive tax, meaning that the higher our incomes are, the larger percentage of our incomes we pay as taxes. In a couple slides, we'll show an example of a personal income tax and how much they pay in total tax using marginal tax rates. Also, payroll taxes are the taxes that an employers pay based on the wage of their employees. These taxes are used to finance Social Security and Medicare. Also, we have corporate income tax. Okay, these are the taxes that corporations pay on their net income, or if they earn any profit, then they pay a certain amount of tax. Excise taxes, these are taxes on a small selective list of commodities. So sales taxes are calculated as a percentage of the price paid for a product. So, here in Harris County is 8.25%. But in excise taxes, it's actually a per unit basis. So, like, you buy a pack of cigarettes, you pay a tax of $1 a pack, or you pay 25 cents for a gallon of gas tax, etc. Usually excise taxes, sometimes it's called the sin tax because, they'll tax alcohol and tobacco. And then all other makes up 6%. And how does the federal government spend their money? Pensions and income security is the biggest portion at 37%. Healthcare, 23%. Defense, 19%. Interest on public debt, because the government does, technically owe money. So, to anyone owning a government bond. Okay, we talked about these in the previous slide, so we'll move on. Okay, so we see here that any income between $1 to $17,850, the marginal tax rate is 10%. Okay, so the highest income here is $17,850, so 10% of that, the total tax is $1,785. And then the next tax bracket is $17,851 to $72,500, and the marginal tax rate on this is 15%. And then the one after that is $72,501 to $146,400, so 25% for over here. And then so on. You can see the next tax bracket. So how are people actually taxed? Let's say your income is $150,000. Okay, so on the first $17,850 of their income, they're going to pay the 10% rate. So they're going to pay the total of $1,785. And then the next bracket of their income, they're going to pay 15% on their income from $17,851 to $72,500. Since they make more than that, they'll pay the full amount of $9,983. They're also going to pay the full amount in the third bracket because their income is above this. So they're going to pay the total tax of $28,453. And here in the final bracket, okay, so their income is 150,000. This bracket starts at 146,401, so we would subtract this 150,000 by 146,401, and we get $3,599. And so they would pay 28% tax on each of those dollars. So we will multiply 3,599 by 0.28, and we get $1,007.72. And if we add it with the other tax rates from the other bracket, okay, the total tax rate here would be $41,233.72. All right. So state governments also earn money from tax revenues and then spend money. So here we have that sales tax and excise taxes account for almost 50% of all tax revenues. Personal income taxes is 34%. Corporate income tax is 5%. And then the revenues they earn from licenses and other things such as fees from registration stickers, etc. It's 12%. How do they spend their money? Okay. 36% is education, so about 1/3 is on education, another third is on welfare. We see health and hospitals, 8%, highways 7%, public safety 4%, and then a variety of other things make up 15%. And local governments, this, includes counties, municipalities, townships, school districts, cities, towns, and most of their revenue, a big chunk of it is from property taxes. Sales and excise taxes, 16%, personal and corporate income taxes, 5%, all other 4. And what do they spend it on? Education is the most, followed by a combination of different things. That's all other 16%. Then it would have to go to welfare, hospitals, public safety, parks, sewage, housing, and highways. U.S. Government employed about 16% of the U.S. labor force in 2011. So that's a big chunk of the labor force. And we see here that for federal employees, that's 2.8 million people in 2011 here. A big chunk of them were in national defense and then the postal service, followed by hospitals and health, because some of these hospitals and health facilities are federal owned, and then police, natural resources administration, and other. For local and state, a lot of the employment comes from schools, then higher education, and then of course health, hospitals, police, corrections, highways, public welfare, and so on. There's a couple of different philosophies on how the tax burden should be apportioned. The first is the benefits received principle, and that's where people who benefit from the good or service should be the ones who pay taxes for that good or service. So, for example, gasoline taxes finance highway construction projects, and so the people that drive the most consume the most gasoline, unless of course you drive a Tesla, and so therefore you are helping finance a project that is of benefit to you. This isn't always applicable, for like a welfare program. Families that are on welfare, it would be a little odd to ask them to pay taxes to finance their own welfare program. Also, there's the ability to pay principal. Okay. And this one is basically those with a higher income should pay more taxes. Economists will say, well, higher incomes, there's higher the income, the less marginal utility each dollar gives. Of course, not everyone always agrees with this. Some people might earn more money. Let's say a family of 4 and, the total income's $100,000 versus just a one person earning $100,000. A family of four might, obviously has more expenses. The tax burden might seem a lot heavier to them than if it's just someone making $100,000 supporting themselves. In other ways, there's just no perfect way to pay taxes to make everyone happy. They're necessary for public goods. I mean, if we had zero taxes, then we would all have to pool our money together, let's say for a public road, and whoever didn't pay taxes, we would have to ban them from using it, but that is so hard to do. Or, you might pay for a street light, but your neighbor doesn't, but yet they benefit from the street light. So that's why, we do tax and we use it for common public goods. Okay, so different tax rates. There's progressive tax, and so the tax rates increase as income increases. Regressive tax, tax rate declines as income increases. And proportional tax, and that's basically it stays the same as income increases. Here in the United States, we have a progressive tax, as we saw in that example. The higher your income is, then the higher the tax rate is in certain income brackets. As I just mentioned, personal income taxes, those are progressive. Of course, there's always exemptions and rules, but in general, the higher the income of an individual, the more they pay in taxes, or the higher their effective tax rate is. Sales taxes actually tend to be a little regressive. The reason being is someone with a very high income, doesn't spend all of their income. Usually they'll save a good portion of it, whereas a poor person, they don't really have a lot of extra income to save, so they tend to spend all their income. So as a percentage of their total income, sales taxes pay a higher percent of their income in sales taxes than a richer person would. A corporate tax is proportional. Any corporation that has a positive profit will pay a flat 35% tax rate. Of course, you may hear about loopholes, and that is true, but the basic tax rate that's levied is 35% all across the board. And then a payroll tax is regressive. The reason being is that the Social Security tax that is paid, it only applies to a certain limit, to a certain cap. In 2012, it was $110,100. And then anything after, any income after that, there's no payroll tax taken for Social Security. So the higher the income is, then the less Social Security tax you will pay as a percent of total income. Tax incidence is the degree to which a tax burden falls on a particular person or a group. However, we'll look at who really pays the tax, and it depends on several things. So our example is going to be with an excise tax, and who really pays the tax, or how much of the burden falls on a particular group of person. It depends on elasticity, and regardless, a tax will cause a deadweight loss, which is a loss of efficiency, but how big it is, how big the deadweight loss is, once again depends on elasticity, and also how much of the tax goes to the government also depends on elasticity. So we'll do a few examples. All right, so here we have a graph. This is showing a tax on wine. More specifically, the tax is levied on the producer of the wine, because here we see the supply curve shift. And if it was levied on the consumer, then it would be the demand curve that shifted. Okay. So at the original equilibrium, okay, which is over here, the producers will produce 15 million bottles of wine, and consumers will demand 15 million bottles of wine as well at $8 a bottle. And so we could see here, total surplus would be this triangle over here, and there would be no dead weight loss. Okay. However, let's say there's a tax imposed of $2 on the sellers of the wine. Okay. This would shift the supply curve upwards. Okay. They would have to sell the wine for $2 more a bottle in order to get what they were to get per unit per bottle that they were before. So, for example, if they were selling it for $8 a bottle before a tax, that's what they were receiving. With a $2 tax, they would have to sell the wine for $10 a bottle. That $2 goes to the government as tax revenue, and then the producer is receiving the $8. However, law of demand says what? That the higher the price level is, okay, the lower quantity demanded. Okay, so this poses a little bit of a problem here. Okay. Okay. If by chance the seller were to start selling the wine for $10 a bottle, okay, then consumers would only demand 10 million bottles of wine, and suppliers would be willing to supply 15 million bottles, okay, at that price. So there's a little bit of a mismatch here because supply would be much higher than demand would be. Okay, and this red line here should be crossing this point right here. Okay. Okay. So that's not going to necessarily work. And what ends up happening is you can kind of see it as a little bit of a compromise, but producers, okay, over here, will charge $9 for a bottle of wine. This will be the new equilibrium. Actually, let me color it in red. This will be the new equilibrium. And consumers at this point would demand, let's say, 12 bottles of wine. Okay. So who shares the tax? All right. Well, before in equilibrium, okay, consumers paid 8, producers received 8. Okay. Now, producers charge 9, so consumers are paying 9. Okay, so we look at before tax. Consumers paid 8. Producers received 8. Okay. After tax, consumers paid 9, and producers received 7. Okay, because yes, the producer paid 9, right? But $2 of that is going to go as a tax. So producers receive 7, so both the consumers and producers bared the burden of the tax. Okay. Consumers paid $1 of the tax. So before the tax, they will pay 8. Now they're paying 9. Producers also paid $1 of the tax as well. Before they would receive 8, and now they're only receiving 7. Okay. So here is what we call the deadweight loss. This is the loss of output that resulted from the tax. Before it was like 15 million some bottle of wine. Now it's 12 million bottles of wine. Okay. Let me change the colors up a little bit, kind of running out. All right. This is the consumer burden of the tax. This is the producer burden of the tax. So this total area is tax revenue. Okay. Right here, this is consumer surplus. And this is producer surplus here. Okay, so there's also been a loss of surplus as well. Before this whole, like we said before, that whole triangle would have been total surplus, half of it consumer, half of it producer. Now we have some deadweight loss, tax revenue that goes to the government, and decreased consumer and producer surplus. Okay. Now let's look at an example where demand is elastic and then another one where demand is inelastic. Okay, when demand is elastic, that means consumers are sensitive to a change in price. Their percentage of quantity demanded changes by more than the percentage change in price. So here we are in equilibrium over here. And then the tax is levied on the producer. So again, it shifts the supply curve to the left where it says ST. Okay. Okay. So before the equilibrium price was price 1. Okay. Now with the tax, what producers pay, what consumers pay is price E. So you can see the change here is not too much, but what producers receive is price A, which is a much bigger change. So, and this theoretically makes sense because, when consumers are sensitive to a change in price, their demand can drop off to a great point. And as we see here, before demand was Q1, and now it's with the tax and the higher price, it's Q2. So producers don't want to lose too much business, so they end up bearing the burden of the tax, so not too much of it falls on the consumer. But if we look at inelastic demand, and so what would be inelastic? Goods such as medicine, and then necessities, toothpaste, toothbrushes, let's say deodorant. I know this isn't very romantic right now, but these are goods that are that have inelastic demand. And so we start off at equilibrium, point B, and then a tax again is levied on the producer, shifting the supply curve up over here. And so if the price of my toothpaste, or let's say just in general, if all toothpaste go up, okay, maybe I'll just use a smaller amount on my toothbrush, and I can stretch that tube just a little longer, but I'm still going to have to buy toothpaste, right? So my demand in general doesn't change very much. I'm willing to pay the higher price, and that's what we see here, is that that consumers go from P to P1. Okay, and producers receive PB. So they used to receive price P, now they receive price PB, and you could see this is a much smaller change. Sorry, I know that's a squiggle right there, but it's much smaller change for producers than it is for consumers. Okay, so moral of the story, okay, is that when demand is elastic, then tax incidence falls more on the producer, and when demand is inelastic, the tax incidence falls more on the consumer. Okay, what about when supply is elastic versus inelastic? Okay, so let's look at the first case. All right. Okay. So since suppliers here are able to easily adjust their supply, okay, what we see is more of the tax burden falls on the consumer. When consumers pay, PE to P is much larger than what we see, just this little difference here with producers. And again, this is because in this case, producers are sensitive to price changes. They can alter their supply much easier than if it were inelastic, and so they can pass off the tax burden to consumers easier. All right, and then when supply is inelastic, so something such as like diamonds or gold or antiques, okay, the supply itself cannot be altered so easy. Okay, and so what we see is consumers just bear a small portion of it, and producers bear more of it. What we see with both inelastic demand and inelastic supply is that the deadweight loss is much smaller okay, when supply and demand is inelastic. Okay, so this helps policymakers. This is important. Policymakers will look at this. They want to minimize deadweight loss and, maximize the amount of taxes. And so their best bet is to place taxes on goods and services that are inelastic, and also goods and services that have an inelastic demand for them as well. Okay, we went over this in the first slide, but it never hurts to go over it again. So once again, this is a deadweight loss that's occurred because of a tax. Okay, so since taxes raises the price that consumers pay and reduces what producers receive, okay, it causes a loss in output. Before, for example, with the wine, it was 15, now it's more like 12 million bottles. And then this darker blue is the tax that goes to the government that is paid by the consumers. This lighter blue is the tax that goes to the government that's paid by the producers. The whole blue box itself, okay, that's just government revenue. And then we have consumer surplus here and producer surplus here. So in other nations, sales taxes are higher, excise taxes are higher, and also they have a VAT tax. That's a value added tax. We do not have that in the United States. A VAT tax is a difference between the value of a firm's sales and the value of its purchases from other firms. Some economists will say this is an attractive tax because it penalizes consumption. And therefore, since once we're done paying the taxes on goods, they become so expensive that we instead spend less money and save more, or we put that money into investment projects. Of course, in the United States, since we are very consumer driven, 70% of our GDP is based on consumption. This tax would worry some economists. They cite that it would hurt the economy instead. We can see in this chart that, Hungary and Sweden, New Zealand pay much higher taxes on general consumption than, for example, than the United States does. Okay, we have some of the lowest consumption taxes, and I guess this would explain why we're such a consumer-driven economy. Okay, so we can look at different types of taxes and who bears a probable incidence. Personal income taxes, well, that's pretty much the household or the individual. Depending, right, if you're married, then, you're going to file as a household. If you're not, file as individual. Payroll taxes, workers pay the full tax on their earnings, and then part of the tax that's levied on their employers pass it on to their employees. Corporate income tax, okay. In the long run, workers pay it because, through lower wages, lower raises in the end. But in the short run, it does fall on the actual business. Sales tax, the consumers, excise tax. Once again, this depends on elasticities. And then property taxes. Okay, so if you own your own house, then, it falls on you. But if you are a landlord and you rent out to tenants, then, you'll include that as part of their rent. So it's usually the renters that bear that tax. Okay, so the overall federal tax system is progressive. That we've seen, the higher your income is, the more you pay in the different income brackets. The higher the taxes in the different income brackets. But the state and local tax structures are regressive, and that is because higher income individuals pay a smaller percentage of state and local taxes as a percent of their overall income than poorer people do. But the overall U.S. tax system is progressive, and this is because we don't rely so much on value-added taxes or national sales taxes like other countries do. We rely very much on personal income taxes. Okay, a big concern for many countries is, is there an equal distribution of income, or is there high income inequality, where there's a lot of rich people but also a lot of poor people? And income inequality is a concern because economists truly believe there cannot be a sustainable economy without a strong middle class. It's the middle class that drives the economy forward. And so, economists looked at, the rich do pay more taxes, but do they flow back to the poor? And they found that, yes, it does. Why? Because taxes go to the government as tax revenues, and as we saw in earlier charts, that the government does spend money on welfare programs and even on education, and, for example, like Pell Grants, for example, to help poor people get an education, and that tends to be the great equalizer as well. So the bottom 40% in the United States in income receive more government spending than they pay in taxes, and then the top 40% of income earners paid more in taxes than they received in government spending. Okay, and we can see here, so the bottom 20%, the green bar shows spending received, and then the red is taxes paid. So the bottom 20, and then the second 20%, okay, we can see definitely receive more spending than in taxes paid. And then as we go to the third 20%, it's almost, still spending received is greater than taxes paid. But then the fourth 20% and the top 20%, they paid, especially the top 20%, paid much more taxes than they received in government benefits. All right, so this concludes chapter 18.